Welcome back to the Deep Dive. Today we're ripping the cover off a piece of legislation that might seem pretty dense at first glance, but really marked a huge moment for tax compliance in South Africa. We're talking about the Voluntary Disclosure Programme and Taxation Law's Second Amendment Act 8 of 2010.
Yeah, it's a classic bit of lawmaking, actually, doing two big things at once. On one hand, you had this grace period, the Voluntary Disclosure Program, the VDP, and on the other, it kicked off this massive system-wide modernization, touched pretty much every major tax law we have. It got assent late October 2010 and basically reshaped the tax landscape almost overnight.
Right. So our aim today is to give you a really clear, structured look at this sort of twin-track approach. If you're just curious, we'll unpack the policy thinking behind it. But if you're, say, studying law, we'll try to nail down those crucial legal definitions and the high-stakes game of the VDP. Because the story here is really amnesty for past mistakes, but in return, demanding digital accuracy going forward.
Exactly. So let's start with Part A, the VDP itself. That was the amnesty offer, right? Designed to bring hidden money into the system. But first, you had to know if you even qualified. What were you actually admitting to?
Good point. Let's unpack that first. What exactly did default mean in this context?
Okay, so default. It's basically any failure on your part that leads to the wrong tax outcome. They broke it down into broadly three things. You sent in info that was wrong or incomplete, you just didn't send it in at all. Or you took a tax position that turned out to be incorrect. And any of those had to lead to either the wrong tax assessment, you paying the wrong amount of tax, or, and this must have really annoyed SARS, them giving you a refund they shouldn't have.
Ah, okay. So it wasn't just about deliberate fraud. It could be genuine mistakes in how you interpreted the rules. Which brings us to that phrase, tax position.
Yeah.
What kind of things does that cover?
Yeah, your tax position is essentially the stance you took on your tax return. Like, did you say an amount was taxable, or maybe you argued it was deductible? Did you use a special lower tax rate? If the legal basis for that decision was flawed and it caused that financial error we talked about, well, that's a default the VDP was meant to fix.
Got it. Now, the eligibility rules, the sort of fine print for getting this relief, we know it had to be voluntary, full disclosure. But what about the timing and the money?
Right, timing was strict. The mistake, the default, had to have happened before February 17th, 2010. It was a hard line. And here's a really critical rule, tells you what the VDP was really about. A valid application could not end up with SARS owing you money, no refunds. This was about collecting revenue, fundamentally. They wanted payments coming in, not setting up future claims going out.
Okay, here's where it gets quite interesting. From an administrative law perspective, usually if you know you're being audited or investigated, you're out. You can't apply. Sounds like a definite no-entry sign.
It usually is, yeah. But Section 3.2 gave the commissioner a way around that. A pragmatic override, you could say. They could accept your application even if you were under audit, but only if two things were true. First, the specific default you were confessing to wouldn't have likely been found in that particular audit anyway. Second, and this is the policy angle, accepting your application had to be in the interest of good management of the tax system. It shows they valued getting the full picture and the revenue, sometimes more than just catching everyone already under scrutiny.
That's fascinating. It's like a calculated move offers some mercy to ultimately broaden the tax base. So if a taxpayer managed to navigate all that, what was the big prize? What relief did the VDP actually offer?
Oh, the relief was significant. Huge, actually. First off, total immunity from criminal prosecution for tax offenses under the statutes and related common law stuff, too. That's massive. Then on the admin side, 100% relief from penalties and additional tax. Though, importantly, that didn't cover basic penalties for just filing late or paying late. Those still stood.
And the interest relief seems tiered, designed to reward proactive disclosure over maybe disclosure under pressure.
Exactly right. If you were a standard applicant, not under that audit cloud, you got 100% interest relief, full stop. But if you were one of those exceptions allowed in under Section 3.2 while already being looked at, your interest relief was cut in half, only 50%. So the structure definitely pushed people towards coming forward early and completely clean.
But getting this relief wasn't just automatic. You had to sign a formal, written, voluntary disclosure agreement, the VDA. And that agreement came with a pretty serious warning about being honest, didn't it?
It absolutely did. The relief was totally conditional on you having disclosed everything material. If SARS found out later that you held back something important, a key fact, a significant omission, they could pull the whole deal. They could go after you for prosecution after all, and any money you paid under the VDP. That would just be treated as a down payment on your now recalculated, much larger debt. It basically locked you into honesty moving forward.
Wow, okay, so that really sets a high bar for anyone using that VDP window. And then, almost immediately after offering that amnesty, the government shifted gears completely into Part B, modernization, digital enforcement. Let's move into segment 2 and look at that digital transformation.
Yeah, what's really striking is just how fast they mandated the move to digital, starting with the Transfer Duty Act.
Right. Effective January 1st, 2011. So very quickly after the act commenced. No more paper, basically. Payments for duty, penalties, interest, all had to be electronic. Declarations submitted electronically. And crucially, needing an electronic or digital signature. This wasn't just about making things quicker, was it? It changed the legal weight of submitting those forms.
It's a massive legal shift. When you put that digital signature on, the law basically says you're presumed to know and understand everything in that document. And what's more, if there's a dispute later on, that digital signature is presumed to have been used with your permission and authority. The burden of proof flips. You'd have to prove it wasn't you or wasn't authorized.
Hang on. So it's not just convenience. It puts all the responsibility for security squarely on the taxpayer. If someone hacks my account and submits something, I'm on the hook unless I can prove otherwise.
That's pretty much the practical effect, yes. It forces you to be incredibly careful with your digital credentials because the law treats that e-signature almost like a witnessed sworn statement.
Okay. Moving to the Income Tax Act, there was maybe a slightly softer touch, an amendment about things beyond the taxpayer's control.
Yes, that was Section 89 Quat. It was amended to give the commissioner some wiggle room, discretionary power to say, okay, interest won't be charged, or maybe only part of it, if the reason the interest built up was due to circumstances beyond the taxpayer's control. Think floods, serious illness, maybe some massive systemic failure at home affairs preventing documents. Things genuinely outside your power. It added a layer of fairness.
And then we got the famous 80-20 rule for transport allowances and car benefits, a really practical change for payrolls, effective March 2011.
Yeah, this one streamlined things quite a bit for pay-away calculations. It dealt with travel allowances and company car fringe benefits. The starting point, the default was, assume 80% of that allowance or the car's value is for private use. So 80% gets included in the employee's remuneration for tax.
But the crucial exception was for business use, right?
Exactly. If the employer was satisfied and they needed to be genuinely satisfied, likely needing logbooks or justification that at least 80% of the travel or car use would be for business, then the rule flipped. In that case, only 20% of the allowance or benefit value had to be included in remuneration. It made payroll much simpler by setting a clear threshold based on the primary use.
Right. Okay, let's move into segment 3 now. This modernization push didn't stop there. It extended out to customs, VAT, mineral royalties. Starting with customs, it sounds like they broke down some information barriers to help tackle trade issues.
They did. A key change was explicitly allowing the SARS commissioner to share import and export data with the chief commissioner of ITAC. That's the International Trade Administration Commission. This is vital because ITAC handles things like tariffs and investigating dumping claims. They need accurate trade data from SARS to do their job effectively.
But for anyone worried about data privacy, this information wasn't just being scattered everywhere, was it?
No, absolutely not. The act was very specific. While SARS could share data with certain other key bodies, think the Reserve Bank Governor, the National Police Commissioner, National Treasury, those bodies were legally bound by confidentiality. They could not pass that information on further unless it was strictly necessary for doing their own official jobs under their own specific laws. The confidentiality principle remains strong, even with targeted data sharing.
Okay. And turning to VAT, there were some practical updates, one for small transactions, making things a bit easier.
Yeah, that was quite simple. If a sale was for R50 or less, the supplier didn't need to issue a full formal tax invoice. They just needed to provide some kind of acceptable document that satisfied the commissioner. Just cut down on unnecessary paperwork for small cash sales.
But then for secondhand goods, the rules got much stricter. It sounds like they really tightened screws there.
Oh, definitely. The record-keeping requirements for vendors buying secondhand goods or repossessed goods became intense. They now had to verify the seller's identity if it was a person against their ID document. And this is the big one. They had to keep a photocopy of the relevant page of that ID. Plus, they needed proof of payment, the date of payment. It was a clear move to combat fraudulent VAT input claims using phantom secondhand goods, and maybe also aimed at making it harder to sell stolen goods through legitimate channels.
Right, that makes sense. Finally, there was an adjustment to the Mineral Royalty Act penalties, a bit more breathing room for mining companies.
That's right. It acknowledged how tricky it can be to estimate future mineral royalties accurately, given market volatility and geological surprises. Previously, you'd get hit with a penalty if your estimate was off by more than 10% compared to the actual royalty due. This act doubled that margin for error. The penalty for underestimation would now only kick in if the difference was more than 20% of the actual royalty. Just a more practical threshold for a difficult estimation process.
Okay, so if we pull all this together, Part A with the VDP amnesty and Part B with all the modernization and tightening up, what's the big picture? What's the main takeaway from this act?
I think the act really shows a major strategic shift by the state. On one hand, it basically admitted how hard it is to chase down every past tax evasion by offering this sweeping VDP 100% immunity from prosecution for past issues. It was like a giant reset button.
A one-time clean slate offer. But the price for that clean slate was signing up for a much more rigorous, digitally monitored future, wasn't it? Mandatory electronic payments, these legally powerful digital signatures shifting the proof burden, much tougher checks in risky areas like secondhand goods.
Precisely. That dual approach sends a really clear message about the government's priorities moving forward. Tax administration had to become high-tech, highly visible, and non-negotiable. So the provocative thought this leaves us with, I think, is this. When a government offers such broad forgiveness for the past, like total amnesty, but at the exact same time imposes this really strict, digitally enforced regime for the future, what does that trade-off really tell you about what the state values more in the long run, voluntary compliance drawn up by mercy or enforced compliance guaranteed by technology?
That's a really potent question about the balance between state power and taxpayer behavior. Thank you for walking us through the complexities of this act. Now it's over to you, the listener, to think about what this all means in practice.